Remember, today being a Wednesday, we talk about money because we want to be financially free. We want to grow together. And we want to help you get out of debt. Yeah, we want to help you get out of debt and also help ourselves get out of debt.
Kama mimi kwanza.
Kama wewe. Yeah.
Kuna madeni.
I was talking to a friend 2 weeks ago, and I said we were talking about money, and he's brilliant when it comes to money and investment and nini. And I was just listening, and I told him, you know what? I think my problem is managing it. Yes, I can find a way to make it, but now managing it. Managing the money is a problem. In studio, we do have Felix Birongo. He is a certified public accountant.
Yes.
Felix, good morning.
Good morning to you.
How are you doing?
I'm fine. I'm doing okay.
Karibu sana.
Asante. Thank you so much for having me.
Yeah.
And we'll continue this conversation about the investment journey that we've started. I think this is the third episode.
Yes.
Yeah.
And I want us to just do a recap of of what you had, the conversation you guys had last week before we get into stocks.
Okay, thank you. So last week we talked mainly about investing in government securities.
Yeah.
We talked about treasury bills and treasury bonds, and we understood the difference between a bill and a bond. And then we also mentioned the fact that investing in treasury bills or treasury bonds is a risk-free. It's a risk-free investment, and then we made a contrasting between now investing in the bonds which are risk-free and investing in share capital or investing in stocks, which is a more volatile kind of investment. And then we try to understand the different risk profiles for people while deciding the kind of investment that they are going to undertake. Yes.
Okay. When you mentioned investing in bonds, it's a risk-free investment.
Yes.
Could you break that down?
So what it means is that, you see, last week we understood that when you're investing, there are two things that are involved.
Yeah.
There's the initial money that you're putting into the investment, and there's the return that you're getting from the investment. So for a risk-free investment, it's an investment where your initial money, the principal, is secured. There's no chance of losing that money. So it means that if you invest, it's 100,000, you are guaranteed to get your 100,000 back with the return.
Okay.
And another thing is that there's no default.
Yeah.
Like the government cannot default on its debt. That's why it's called a risk-free investment.
So your investment is secure.
Very secure.
Okay. And since you mentioned 100,000, how is it? I want to know if it's short term, if it's long term.
Now, the short term or the long term on the government securities is it's split into two. So the treasury bill is the short term kind of investment, where, as we learned last week, you can invest either in a 91-day treasury bill, a 180th treasury bill, and a 365-day treasury bill. But now the treasury bonds, now these are long term. They are called infrastructural bonds, and you can invest them depending on the kind of infrastructural bond that is on issue. Then you can invest for longer, even 25 years. But it doesn't mean after you've invested in that bond, your hands are tied. You can opt out in between. But for you to wait until maturity, it takes longer, and it depends with the type of infrastructural bond that you've purchased.
Yeah.
Yes.
All right. Now that is a conversation that Felix had with the boys last week, and you know what? It's on YouTube. If you go to Swahili Pot FM on YouTube, you'll find that conversation. Today we are looking at stocks, understanding stocks, and also why people should invest in stocks. So why should an average person consider investing in stocks?
I think for one to decide whether they are going to invest in stocks, first you need to understand what investing in stocks entails. Actually, what's a stock first? You get to learn it, you understand it, and then depending on the knowledge that you'll have gotten from understanding how that market works, then you can decide. One, there's what is called capital gain. When you invest in the stock market, there are chances that your capital is going to increase, especially if you invest in the companies that are called blue chips company. These are companies that have a high value in the market, and because their shares are in high demand, then the share value will keep on increasing, because it's guided by the laws of demand and supply. Because the shares are in high demand, then the price will increase as the demand increases.
Yeah.
So now you'll get that capital growth of the money that you invest, but it's not always guaranteed. That's why last week we said it's a volatile market.
Yeah.
There's that possibility of the prices increasing or decreasing. It fluctuates every day.
Yeah.
And then now also investing in these blue chip companies also gives you return. Like you have the possibility of earning a dividend either once every year or twice every year, depending if the company decides to pay an interim dividend and then a final dividend. But now the dividend that you are going to earn is not fixed. Like you get maybe 1 shilling per share dividend.
Yeah.
Don't assume that next year you are going
That's
to
what
get
you're
the
going to
same.
get. Yeah.
No, it depends on how the company will perform. And then now dividends are paid from retained earnings. So the company will do trading, they'll make their money, their profit at the end of the year. Then there's going to decide that out of the profits that we've made for this particular year, we are going to retain this much in the government, in the company, and we are going to distribute this much to the shareholders.
Okay.
Yes.
I like that. I want to take you back. So you've already explained what a stock is.
Yes.
You've mentioned blue chip company. How do I know? How do I know a blue chip company?
It's easy to know a blue chip company because one, there's what is called a share index.
Okay.
So you'll find that in our case in Kenya, the trading platform that people use to trade in the security exchange is called the Nairobi Security Exchange,
Yeah,
NSE.
NSE.
So you'll find that NSE picks companies that are performing well, and they put them in let's call it a basket, and they call it. For instance, there's a basket of 10 companies that are well-performing companies that is called the NSE 10 index.
Yeah.
So it tracks the performance of those companies and how they are performing, and then now they base the performance of the entire market based on that NSE index. There's also the NSE 20 share index, which is a list of 20 companies that are good performers.
Yeah.
They've been performing consistently over time. And then also when you do your research, you're going to get so many articles online that are telling you that this is a blue chip company. And blue chip companies, like the word itself is more self-explanatory because these are companies that are high performers in the market, as opposed to what is called penny stock companies, which will find that their shares are selling at less than a penny. That's why they're called penny. So maybe in our case, you'll find companies that whose shares are selling for less than a shilling, less than 10 shillings, less than 100 shillings. But you'll also find companies that their shares are selling for less than 100, but they are also considered blue chip companies because of how they are performing. So you'll find they're selling one share at 10 shillings, but when you look at the capitalization of that company, so market capitalization, you take the number of shares that the company is authorized to issue, you multiply by the par value of that, and then you find it's in the billions. So you find one share is selling at 10 shillings, but there are so many billions and millions of shares on offer. So that makes it that the market capitalization of that company.
Okay.
Yes.
Now, for somebody who's, because now we're all thinking about it, and maybe I have some sort of savings. I have money in my savings account, and I don't know much about stocks. All I hear is everybody talk about, invest in stocks, invest in treasury bonds, and we were told money market fund is not an investment. So I hear all these things, and I'm thinking, where do I start? Where do I start when it comes to investing in stocks?
So once you've made that decision, it's very important to mention that you get the information, you learn about investing in treasury, in securities or in share capital. Then first, don't make that decision first.
Okay.
That's why the first conversation that you had was ensure you have what is called an emergency fund. So make sure that you have money for an emergency. Don't take all your savings and put them in the share capital market.
Okay.
Because there are high chances, not given, but there are chances that you will lose that money. So when you're deciding to invest in the stocks, be certain that there's the possibility of making money or losing money. So don't take all your savings and put them in in the stock market. So when you want to invest in the stock market, to invest in the stock market using something that is called a CDS account. CDS stands for Central Depository System. So it's an account that tracks the number of shares that you hold in what company you are holding these shares. Back in the day, people used to get what was called a share certificate. So you buy shares in a company, you are given a share certificate. Now this share certificate is proof that you are owning this number of shares in this given company. Now that was phased out.
Okay.
After it was phased out, they brought the CDS
CDS.
account. Now this CDS account tracks the number of shares that you have and in what company. So the first step is to open a CDS account. How do you open a CDS account? You open a CDS account through a stockbroker.
Okay.
A licensed stockbroker, because nobody is allowed to trade in the NSC directly. You have to trade through a stockbroker. So there are a list of licensed stock brokers. So you go, you learn about them, because they make their money by charging you a commission. So it's good. It's also important to look at how much are they charging as commission per transaction.
Yeah.
So once you've decided the kind of stockbroker you're going to deal with, then you approach them. They help you to open a CDS account. So for you to open a CDS account, you only need your national identity card, your KRA PIN certificate, and proof of residence. You need to prove that you are a resident in Kenya. Now you can prove that using either a bank statement or a utility bill. So once you have that, you will fill forms, then they'll open the account for you. So once your account has been opened, then you need to fund that account. How do you fund that account? Your stockbroker will tell you. Depending on the amount of money that you want to put into the account, you can do a bank transfer, you can do via M-Pesa. That depends on what your stockbroker policy is. So once you've funded your account, then you do your research. What company do you want to invest in? So you decide now, I want to invest either in a blue chip company or in a penny stock company. So you can say maybe, let me invest in Uchumi supermarket. Their shares are selling for a couple of cents. It doesn't even get to a shilling. So for you, you decide now I'm investing in Uchumi supermarket, and then now you place the order. Now, how do you place the order? You can place the order and tell them buy immediately, or you tell them buy when the price gets to this value. Okay?
Yeah.
So you tell them that, and then they'll execute that order for you. And then once you've done that, you would have bought those shares. They get into your CDS account. Now you can decide to, after that has happened, now you track how the share is performing. So you see if it's performing well or it's performing poorly. Then now you can decide, now you're going to sell, you're going to buy more, you're going to buy a different company, and then now you start what it's called the trading. Yes.
Kazi hii ya leo ni ngumu.
Ama kwa sababu ya kizungu.
Hata si kizungu. Hii stock kidogo ni zile walisema risk. Hii ni risk. Anyway, Felix, mimi swali langu linakuja hapa kwa sababu umesema kwenye kujisajili huko na ukataja blue chip na penny, hiyo za mapeni hazifiki hata shilingi. Now kuna uwezekano mimi ambaye kwamba nataka kuwekeza kwenye stock ni kakuwa na entity mbili. That is
you buy shares from different companies.
Exactly.
Yes, very possible. You can buy shares from as many companies as you want. No restriction. The only caveat ni shares zinauzwa in bundles of 100 shares.
Okay.
So kama share moja kwa kampuni fulani inauzwa 20,000, you must have 200,000 to buy hizo 100. I think yes, my math is correct. So if it's 1 bob, you can buy with 100 shillings. But now you buy it in bulky because of the commissions. You'll find that the stockbroker charges you a fixed commission or a percentage commission. So if they are charging a fixed commission, and there's a minimum commission that they are going to charge you regardless of the amount of shares you're buying or selling, that will determine how much and how frequent you are going to be buying and selling the shares.
Now swali jingine, kwa sababu tunawekeza ili tupate faida. Huo ndio mfumo wa maisha. Now kumesema kuna hiyo kufuatilia.
Yes.
Wakati umeshanunua shares zako na bla bla, unafuatilia. Ikifika sehemu ambayo umeona hii imetengeza pesa, of course umesema kuna hiyo ya mwaka mzima unapata dividends, right? Na kuna nusu mwaka unapata either 2 ama once.
Correct, yes.
Unapata hizo. Lakini so ikifika mahali nimeona hela imekuwa nzuri, tamu, inapendeza, nafanyaje ili nitoke? Nichukue hela yangu niondoke zangu?
You place a sell order. So naambia stock broker wako, mimi nataka kuuza shares zangu. Namwambia stock broker nataka kuuza shares zangu. So nakuuliza ni share ngapi unataka kuuza, naambia uza zote. Sawa. So depending on the price on the day they are selling, hiyo ndio pesa yenye utapata. Utoke nayo. So iza kwa ulinunua share ikiwa ni shilingi 1, unauza ikiwa ni 50 cents. So utakuwa ushapoteza nusu ya value yako.
Yeah.
Ulinunua ikiwa ni 1 shilling, sasa imefika shilingi 5, utakuwa umetengeneza shilingi 4. Then ukishauza utalipa what is called a capital gains tax, cause capital yako increase, you pay the capital gains tax and then the balance unapata.
So let's talk about because you spoke about volatility, right?
Yes.
And you said you can lose it, you can lose money.
Correct.
Let's talk about that risk.
Okay, so that's a very broad question. You need to be
okay,
specific.
so the risk, when you talk about, because
Yes.
people here it's rising. Okay, I'm just gonna, in layman terms,
Yes.
it's rising and then it's dropping.
Correct.
So Salim wants to cash out before
Before
it
timing.
drops. Yes,
The
before it
timing.
drops. Ni kama ile game tuko tunacheza.
hiyo kakufly.
Yeah. So basically what normally happens in the market, the things that will make the price of a share to increase.
Yeah.
One is you'll find, maybe I'll give you an example of Safaricom. Now Safaricom, a couple of years back, they were investing in Ethiopia. So now when they were investing in Ethiopia, there were chances that the value of Safaricom was going to increase.
Yes.
So everybody wanted a piece of Safaricom before the prices go up. So when everybody wants a piece of Safaricom, there's high demand in the market. That high demand in the market will cause the share value of Safaricom to increase. That's one reason, the demand.
Yeah.
2, they are going to give what is called a dividend notice. So they are going to say that we'll pay dividend in the next 3 months. Now this dividend can be either, when you're buying shares, you can buy a share either come dividend or ex dividend. So it says when you're buying it, maybe you're buying it today and the dividend notice has been given. So if it's come dividend, it means you're buying it with the dividend that was announced.
Okay.
If you're buying it ex dividend, it means you're buying it without the dividend.
Okay.
So it means whoever sold that to you will get the dividend, not you.
Oh.
So you find, but in most cases they're sold come dividend. Okay. So you buy it today, you're going to get the share, because they say we are going to close the share capital book, ordinary share capital register on this particular date. So it means anybody that is on the register as at that date will earn the dividend.
Yeah.
So everybody will want to buy those shares. So that makes the prices to also increase.
Yeah.
And then now it can start performing poorly.
Yeah.
For instance, there's a conversation that is ongoing in the social media about people now boycotting Safaricom and moving on to Airtel. So maybe that can have an impact on the performance of Safaricom. People might now start to think that now Safaricom will no longer be profitable as it used to be. If that yields something substantial or major, it's going to cause a major shift of brand loyalty from Safaricom to Airtel.
Yeah.
Now that will make Safaricom shares to lose their value.
Oh, so that's an example, right?
Yes, an example
Okay.
that might make it to lose its value.
Yeah.
And then now people will start selling. Now if people start selling, then people will start feeling, I shouldn't hold on to my Safaricom shares. So everybody wants to sell. The market gets flooded with Safaricom shares that are on offer. So if it gets flooded, then the price will definitely go down.
Oh.
Yes, so that's how the volatility happens. And then there's nobody that fixed fixes the market, the prices at this value. It's left to the laws of demand and supply. So they will, like you find yesterday, they closed trading at say 20 shillings per share. Today they might open on that, but now who decides the value? The value will be decided by the first offer that is made in the market. So maybe Salim wants to buy shares in Safaricom. He has a lot of money, tells his stockbroker, I want to buy shares worth 1 billion in Safaricom. He places that order in the market, and when he places that order in the market and he says, I want to buy them at 19 shillings. So somebody must be willing to sell their shares at 19 shillings. It doesn't mean that these shares are available for you to buy. You place an order to buy, somebody likes your offer and says, now I'm agreeing to your offer, I have this number of shares. You want to take them. Now, if he places that and then another person will say, he's asking for 19, give me 18 shillings. Okay? Another one says, give me 15. So that makes the market to start moving. Once it starts moving, now Salim's stockbroker will say, now I'm buying it at 17 shillings. So now the next person who places them on offer next says that I want to sell. You will look now, do I sell at 17? Do I sell at 18? But if there's nobody who is willing to sell or to buy, then the prices will either go up or it goes down. So the market movement is what determines the prices. Place an order to buy or to sell. Somebody accepts your order at a given value, and then now that sets the precedent. Then the next trade will be based on that, but it will not be guaranteed that it will be done at that value. Somebody will say, we started the market at 19, it went to 21, later 15, later 30. Let me wait until tomorrow. I don't want to sell today.
Okay. And because I feel like I need to take a break, but there's so much. You mentioned trading as well.
Yes.
Now, again, there's somebody who has, I do have money in my savings account. I want to invest in stocks, but there's a lot involved, right?
Yes.
So you've said that I need to involve now a stockbroker.
Correct.
Right? So if I involve a stockbroker, does that mean that they do everything on my behalf without me having to get involved in understanding whether the market is whether things are rising or that the stock is dropping? Is that the role of a stockbroker?
No, not mainly.
Okay.
It depends with the kind of contract and agreement you have with the stockbroker. So if you've given your stockbroker full autonomy, then they'll do that for you.
Okay.
But in most cases, you'll find that stockbrokers are only involved in executing orders. So the client places an order to sell or an order to buy. So the stockbroker does only that. So for you as a trader or an investor, it's up to you to do your market analysis. The number of the kind of shares that you've purchased, how are they performing? What do you feel about that? Are they performing well? Are they performing poorly? Do you still want to hold on to them with the hope that maybe they are going to pay a dividend or the value is going to increase? It's you to decide. And then once you've decided, you give your broker instructions, and then they execute those instructions for you.
Okay.
Yes.
Felix, have you invested in stocks? No. Yes, I'll come. Nataka uniambie, I want you to tell us why. We are talking to Felix Birongo. He is certified public accountant. You stated earlier on how to get started, the first step that someone should take if they've never invested before, right?
Yes.
And then what's the minimum amount that someone needs to start investing in stocks?
So the minimum amount that somebody needs to start investing in stocks depends on the type of share that he wants to buy.
Okay.
There's no specific, like for treasury bills, you're told that the minimum amount you can invest is 50,000. But now for the share capital, it's on the stock market. I'm saying share capital because I'm an accountant, so that's the terminology we use. But now when investing in shares of a given company, the minimum number of shares you can buy is 100, and you need to buy it in batches of 100.
Okay.
So you say maybe I buy 100, 200, like that. But the minimum is 100. So if the company that you want to invest in, one share is selling at, say, 100 shillings and you need to buy a minimum of 100, then it goes to say that you need 10,000 minimum for you to invest. But now something that maybe I forgot to mention at the beginning is what we are talking right now is investing in what is called the secondary market. Now, secondary market is these shares were initially offered to the public, and people bought the shares, and now they are reselling it in the secondary market.
Yeah.
But sometimes you can decide you want to invest in the shares, but not in the secondary market, but when they are given for the first time, they are given on offer for the first time, something that is called an IPO, initial public offering. So for us in Kenya, we've had a drought. I think for the last 17 years, if I'm not mistaken, the last IPO I think was during the Kibaki era, that when the IPO were vibrant. But they came and there was a dormancy in the market, and then around 2015, I'm not sure about the dates, but that was when the last IPO was. That's why you find that most people, especially the youth, they don't understand what an IPO is, because it's not something that is spoken about frequently. But now what the government is trying to do right now, they're trying to do what is called privatization. Now, privatization is where you get companies that were public companies, parastatals, to go public, so that now people can buy into those companies. When the current government came into being, they had put a list of, I think, 35 parastatals that they wanted to do privatization for. And then they said we are going to start with 11.
Yeah.
Now, those 11 were supposed to have been privatized back a couple of months back. But then there was some legal battles. But now they're saying it's been approved, and in the next month or two, around September, they're going to do an IPO for the Kenya Pipeline Company. So now yes. So when you do that, what they'll do is the government will, you find that for a parastatal, the government owns majority of the shares.
Yes.
So now for it to be privatized, it means the government must be willing to give away more than 50% of their stake in that company.
So it's selling.
It's selling.
Okay.
Yes, so it's, that's the best word to use.
Yeah.
So they are selling their stake to the public. So when they do that, they are getting money. They get that money, but the government does not take the money. The money goes to their company, because the ordinary share capital is for the company. So you find the government has put those shares on offer. People buy, the money goes into KPC.
Yeah.
KPC uses that money for expansion. So once it expands, then it starts making money, starts paying dividends, then people start buying shares now in the secondary market. So what we've been talking about is investing in the secondary market. That's when you get the CDS account, you trade through your stockbroker. But IPO is a little different.
Now sasa Felix, hivyo ambavyo sisi tumekuwa tukizungumzia, umesema secondary that tayari zilishauzwa, and then sisi tunakuja kununua kutoka baadaye. Now kama hii ambayo sasa I think ni jana kwenye kikao cha baraza la mawaziri wali decide na hii KPC yenye unasema.
Yes.
Wakishasema wametoa wanauza the 50% share kwa mfano.
Yes.
Sasa kwa umma ni kila mtu, au kuna kiwango ambacho kwamba itaekwa pale wale ambao watafikia wafikie?
Haifungi mtu yoyote. So what they do once they've decided that they are going to do an IPO, kuna kitu inaitwa prospectus. Now prospectus ni kitabu chenye kinaelezea historia ya KPC, when they started, how they've been performing. It's more of information to the public, trying to entice them to be interested in buying those shares. Now in that prospectus, they are going to issue guidelines on when you want to participate in that IPO, what are the requirements. So in that requirement, then they are going to say that the minimum you are going to purchase is this number of shares. But you'll find that for an IPO to be successful, they have to look for underwriter. because somebody must decide what's the value of these shares. That's one. Two, they must get an institutional investor, maybe a commercial bank or an investment bank that will be interested. Now, ambie kwamba once you are going to do this IPO, we are going to support this IPO, we'll fund this IPO, and we are going to subscribe to a majority of the shares. So once they've done that, then the other people will now start buying. You can do an IPO and you only sell maybe 100,000 of your shares. Hizi zengine, people will not subscribe to them. Maybe they didn't like how the company was performing. Ama there was so many people felt that the price that you've quoted for that IPO is too high. Then wanachana nayo. Then they can decide, let's now do a second offering. Because now once the IPO has been done, somebody has to subscribe to those shares for it to be successful. It cannot be approved like now we've done it. We've done the IPO and it's only 100,000 shares that have been purchased. This investment banker who backs up this IPO will wanaapa kwamba ile uhakika kwamba we will support you and we are going to subscribe to your shares. Then that gives other people confidence. Because there's no way you are going to buy shares into a company that its performance maybe is wanting, and then you feel that the price is high and nobody wants to buy those shares. Then everybody shies away. So they need somebody to give them that confidence.
Now, hapo.
Yes.
Hii yenye inaanza, yenye sasa zimeuzwa shares, na hii ya secondary
market, yes.
Because this is a world of risk.
Yes.
Which is more risky?
They are all risky.
Okay.
For the beginner, again, who's thinking about buying individual stocks, should beginners buy individual stocks, ETFs, or mutual funds?
Now, those are different things.
Could you break it down?
Okay. Because now shares, you're buying, you're owning a piece of a company.
Yes.
And then you said
ETFs.
This is an exchange-traded fund.
Yeah.
And then, so this is a different class of investment vehicles that I wouldn't want us to mix the two.
So it's not part of this?
Nope. You've mentioned about mutual funds.
Yes.
You've mentioned about ETFs.
Yes.
And then you've mentioned about stocks.
Yes.
So what we are talking about right now is stocks. Now, stocks is owning a piece of a given company.
Yeah.
Now, this other one are different. The process of investing them is a bit different. And if we start talking about them, we'll confuse ourselves.
Okay. I think we can back the ETFs and mutual funds for another day.
For another day, yes.
Okay.
Yes, but those are... They are more like the mutual funds is now like what we are calling the money market fund.
Yeah.
These are unit trusts. Yes. And then there's also another vehicle that is called a REIT, which is a real estate investment trust. So you find you're investing. Now it works the same way as stocks, but instead of owning a piece of a company, you are owning a piece of a real estate property. So there's so many options that people can consider. It's good we focus with like today's stocks, then we keep on learning and breaking down each and every item.
Okay.
Yes.
So you've said that you've not invested in stocks. Why?
The reason why I've not invested in stocks myself is because of my risk profile.
Okay.
I am not a risk taker. I am a risk-averse person. So I prefer investments that, in as much as the return is low, my capital is preserved. So I invest in treasury bills. I invest in treasury bonds because those ones you're guaranteed that you'll get your capital back. But with time, and then another thing I can say, I don't have money that I'm willing to lose. Yes.
So for somebody who's investing in stocks, you need to know
Yes.
you might lose all of it.
Yes. There's a possibility.
But there's also a high return.
Yes. You see, because of the high risk, it works this way.
Yeah.
There's a high risk of you making a killing in that market.
Yes.
And there's also a high risk of you losing everything.
Of you being killed.
Of you being killed in that market.
Yeah.
And now that works that you can enter the market at the wrong time. You find that because now in Kenya, one of the problems that we have is we like getting consumed by a frenzy of things that are happening.
Yeah.
Like back in the day, there was Simu ya Jamii. people started opening them, the market collapsed, people wakaenda kwa M-Pesa, so many M-Pesa shops were opened, saizi zimefungwa. People started opening motorbike repair shops, so many came up in the market and they closed. So you'll find that people who are entering the stock market will find maybe you are entering today because maybe you had Felix at Swahili Port say Safaricom is doing okay and it has been doing okay, and then you decide to enter at that time, and then tomorrow something happens that jeopardizes the performance of Safaricom. A lot of factors, they are called macroeconomic factors, that will determine how that market will perform. And then now people lose confidence in Safaricom, they start selling their stake in Safaricom, and then you lose money.
So what then should I do? And like, what then should I do when it comes to doing my due diligence to ensure that I'm not making a wrong decision?
The first thing that somebody needs to do is, if you want to make money in the stock market, try to think of long term.
Okay.
Don't think of short term, like making a quick kill. You can make or you can lose in the market. So that's why you're told the amount of money that you want to invest, especially now when you're making the decision to invest in the stock market. One, be guaranteed that you don't need that money anytime soon. So if you need that money anytime soon, put it in a treasury bill or put it in the money market fund. It's highly liquid. Now, if you have money that you can spare and you are willing to sit for, say, 2, 3, 4, 5 years, then now you can put it in the stock market. Once you put it in the stock market, then look at how that share has been performing. There are those shares that have been on a consistent growth. You find that their share value has been increasing consistently over a couple of years, not just 1 year. A couple of years, then you can invest on those. And then you find now when the market is moving, it doesn't mean that it moves like by very large margins. It moves by small margins. You find that today it has gained maybe 2 cents. Yesterday it was selling at 1.20 cents. Today selling at 1.22 cents. 3 months later we'll sell at 1.25 cents. So that growth is it's small margins, not very high margins. You make a lot of money because it's small value, but you buy many. So you find that you've invested 1 million shillings and one share was selling at 1 shilling, so you have 1 million shares. So it means if it gains by 1 shilling, you're gaining by 1 million. If it loses by 1 shilling, you're losing 1 million. That's where the aspect of losing money comes. So that money that you've put, it's the total amount of money you've invested, you divide by the value of the shares that you have, so that you know the value per share. So if it increases or it reduces by any margin, that's how much money you are losing. But if you hold for long term, and it's a company that has been consistently performing, and then another thing, it's a company that is in an industry that does not have high risks. Like there are companies, let's say for instance, the companies that are performing right now in Kenya well are commercial banks that have been listed in the stock exchange market. And you find that the central bank has put in a lot of mechanism to ensure the stability of the banking sector. So you don't foresee this market collapsing anytime soon. But now if you go back a couple of years, you'll find that we had a banking crisis when banks were collapsing. I think 3 or 4 companies collapsed back in the day. That cast a doubt in the performance of the banking sector. But the central bank stepped in, put in mechanisms and policies that have stabilized the banking sector. So you find that in Kenya, the banking sector has been on a consistent growth, and it's foreseen. Now, this is not expert opinion. It's foreseen that it will continue in that trend. So you can now invest in the banking sector because it's been performing in that trend. Then you find that maybe the government might now decide to come up with policies that will cast a doubt in this consistent trend. So once you do that, that's why you advise that once you've invested, it's not like ni miti umepanda kwa shamba yenye unaexpect itakuwa. Lakini pia miti ukipanda kunaweza kuja kiangazi ikakauka. So pia in the stock market you also need to consistently monitor, one, the performance of the company you've invested in. Two, you need to be a student of history. You must read a lot, be interested in what policies the government is passing, what laws are being passed that are affecting the sector you've invested in, and are they good policies or bad policies?
Yeah.
Yes. Now that one will give you an edge so that you are not caught with you lose money because you didn't
because you
listen to the
do
market.
not know.
Yes.
I like that you're saying that we actually have to do our research before we invest in anything.
Yes.
In fact, it's in anything.
Yes.
Yeah. Thank you so much, Felix, for making time.
Thank you.
This has been a good conversation, food for thought. I think Salim amedecide he's not getting involved in
huko.
stocks in any way.
Swali ingine ilikuwa iko hapo like kumbe kuna broker ni umlipe, kuna commission yake, hiyo yote lazima uhesabu
All that.
Yes.
ndio ujue utapata faida gani.
Yes.
This business
And there's also the capital gains tax you pay when you sell and you're selling at a profit.
Yes.
Yes.
Yeah. We're not happy about this one today. Yeah?
Yeah,
No, I'm happy about it. I
Yeah,
think if you
the conversation is good.
yes, the conversation is good. We're getting enlightened on. In Kenya, what do you think? If you look at in like a minute,
Yes.
what do you think most Kenyans are investing in?
Right now.
Yes, right now.
That's a difficult question. Let me see. Find people mostly investing in treasury bills
Okay.
and treasury bonds. And these treasury bills and treasury bonds, you find that because of the easy, people are saying it's easy money, and the fact that the government is giving this bi-weekly, if I'm not mistaken, then there's a chance of making money. And the fact that it's short term. For a treasury bill, you find that within 3 months you've made your money. And you put less money, you get more money in treasury bills. I think we mentioned that last week. It's discounted. That's what people are investing in. And then people are also investing in unit trusts, which maybe we can talk about another time.
I think we can do that. We can bank that. Thank you, Felix, for making time. We've been speaking to Felix Birongo. He is a certified public accountant. And you know what? You have questions for him. Where can they find you on social media for people who want to consult you?
People can find me on any platform on social media using my name, Felix Birongo. You can find me on Twitter, Felix Birongo. You can find me on LinkedIn, same name, Felix Birongo. You can find me on Facebook, Felix Birongo.
Thank you for making time.
Yes.
Good morning.